Good evening and welcome. Tonight, we examine a topic that has generated increasing attention among cryptocurrency observers and financial analysts alike: the potential for government action affecting Bitcoin holdings, with discussions centering on the year 2026. This development, while still largely speculative, has raised questions about the regulatory landscape for digital assets, investor protections, and the broader implications for global markets. In this report, we will outline the timeline of events as projected by policy analysts, review the mechanisms that could be involved, and examine the potential impact on cryptocurrency holders and the financial system at large. Over the past decade, Bitcoin has transitioned from a niche digital experiment into a widely recognized asset class. Its growth has been accompanied by heightened scrutiny from regulators and lawmakers across multiple jurisdictions. Governments have expressed concerns about its potential use for illegal transactions, tax evasion, and its impact on financial stability. In particular, certain proposals under discussion suggest that by 2026, regulatory authorities may introduce measures that could, in principle, restrict access to large cryptocurrency holdings. These proposals range from enhanced reporting requirements to more direct controls over exchanges and custodial services, and they have fueled debate among both institutional investors and retail users. The timeline projected by financial analysts begins with a series of incremental regulatory steps expected over the next few years. Initially, authorities are likely to implement stricter reporting obligations for cryptocurrency exchanges and wallet providers. These measures would require these entities to submit detailed transaction data to government agencies. Analysts suggest that such reporting requirements could start taking effect as early as 2024, with compliance standards increasing gradually over 2 years. The aim, according to policy statements, is to monitor large transfers and suspicious activity, thereby creating a clearer picture of cryptocurrency flows across national and international borders. By 2025, projections indicate that authorities could expand the scope of oversight to include non-custodial wallets, peer-to-peer exchanges, and decentralized finance platforms. While direct confiscation of private holdings remains unlikely at this stage, the increased regulatory scrutiny would place pressure on platforms facilitating anonymous or untraceable transactions. Analysts emphasize that these measures are intended to enhance compliance with existing tax laws and financial regulations rather than serve as a prelude to mass seizure. Nonetheless, they acknowledge that heightened enforcement capabilities could set the stage for more assertive interventions if deemed necessary by regulatory bodies. The transition into 2026 represents a potential tipping point, according to the timeline outlined by observers. At this stage, authorities may introduce mandatory registration of large cryptocurrency holdings with government entities. These registrations could include detailed account information and identification verification, intended to reduce the risk of tax evasion or illegal activity. While this step stops short of direct confiscation, it represents a significant expansion of government oversight over private digital assets. Financial analysts caution that any further actions beyond this point would likely require additional legislation or judicial review, ensuring that measures remain within the bounds of national and international law. Simultaneously, experts note that technological developments in the cryptocurrency space could influence how these measures are implemented. Blockchain analytics, wallet tracing tools, and enhanced exchange reporting systems may allow authorities to monitor transactions more efficiently. Such advancements could facilitate compliance and enforcement while minimizing the need for extreme measures. However, the potential for regulatory interventions has prompted investors to reassess risk exposure and consider adjustments to their portfolios in anticipation of increased scrutiny. As these developments unfold, it is important to recognize the legal context underpinning potential government actions. Any attempt at direct confiscation would need to comply with established procedures for asset seizure, due process protections, and judicial oversight. Historical precedent in other asset classes suggests that authorities generally pursue voluntary compliance measures, penalties, or negotiated settlements before resorting to compulsory confiscation. Consequently, while the discussion of a 2026 timeline has captured attention, the actual likelihood of widespread seizure remains the subject of debate among legal scholars and financial analysts. Looking ahead, analysts emphasize that proactive engagement with regulatory developments is critical for investors. Understanding reporting requirements, maintaining proper documentation, and working with regulated platforms can mitigate risks and ensure compliance. Industry groups and legal advisors continue to monitor legislative proposals and provide guidance on best practices, highlighting the importance of transparency in the evolving regulatory environment. With this context in mind, we now turn to the second half of the discussion. In the following segment, we will examine the specific steps that could be involved in any potential enforcement actions, the reactions from the cryptocurrency community, and the broader implications for the global financial system. We will also consider expert perspectives on risk management strategies for investors navigating this evolving landscape. Continuing from our previous discussion, we now examine the potential enforcement measures that could be employed should governments move to exert greater control over cryptocurrency holdings by 2026. Analysts suggest that any such measures would likely involve a combination of administrative oversight, regulatory compliance requirements, and coordinated action through exchanges and financial institutions. For example, exchanges may be required to freeze or restrict access to accounts that fail to comply with reporting obligations, while authorities could introduce penalties for non-compliance or failure to register large holdings. These steps would be designed to encourage voluntary compliance while providing authorities with the means to monitor and regulate activity across the cryptocurrency ecosystem. Financial experts note that any enforcement actions would likely be implemented incrementally. Initially, notifications and warnings may be issued to non-compliant account holders, allowing them to rectify discrepancies before more formal interventions occur. In addition, the role of custodial service providers would be central, as these entities hold the majority of cryptocurrency assets on behalf of investors. By collaborating with regulators, custodial platforms could act as intermediaries, ensuring that enforcement measures are applied within the scope of existing laws while limiting disruption to the broader market. The response from the cryptocurrency community is expected to be multifaceted. Some investors may choose to liquidate holdings or shift assets to platforms operating in jurisdictions with more favorable regulations. Others may engage in proactive reporting and compliance measures to reduce exposure to potential enforcement action. Meanwhile, industry groups and advocacy organizations continue to engage policymakers to shape the regulatory framework, emphasizing the need for clarity, proportionality, and due process in any proposed interventions. Analysts caution that these developments could introduce short-term volatility in cryptocurrency markets, particularly if uncertainty surrounds the timing and scope of regulatory actions. From a global perspective, the implications of heightened oversight in one jurisdiction could influence policies elsewhere. Cross-border collaboration among regulators and financial institutions may result in more standardized reporting requirements and enforcement practices. This, in turn, could impact liquidity, market access, and investment strategies, particularly for investors with international holdings. Analysts note that coordination between countries may also help mitigate risks associated with illicit activity, while ensuring that legitimate investors are not unduly penalized. In terms of risk management, experts advise a structured and cautious approach. Maintaining accurate records of transactions, working with licensed and regulated platforms, and consulting legal and financial advisors can reduce exposure to regulatory action. Furthermore, diversification across asset classes and jurisdictions can provide an additional layer of protection against potential disruptions. Investors are encouraged to stay informed about legislative developments and to assess portfolio strategies regularly in light of evolving regulatory landscapes. It is also important to recognize that technological and market developments may influence the likelihood and nature of enforcement measures. Blockchain analytics, transaction monitoring tools, and compliance software are advancing rapidly, enabling regulators to track activity more precisely and implement targeted interventions. At the same time, innovations in privacy, focused solutions, and decentralized platforms may offer investors additional tools to manage compliance and security. The interaction between technology and policy will likely shape the trajectory of cryptocurrency regulation well beyond 2026. In conclusion, while discussions of potential Bitcoin confiscation in 2026 have attracted attention, the most likely outcome involves enhanced regulatory oversight rather than widespread seizure of private assets. Analysts emphasize that any enforcement measures would be subject to legal safeguards, including due process protections and judicial oversight. For investors, the focus should remain on transparency, compliance, and informed decision-making, rather than reactionary measures or speculative fears. Understanding the regulatory environment and engaging proactively with reporting obligations can help ensure that cryptocurrency holdings remain secure and accessible. As the cryptocurrency landscape continues to evolve, ongoing monitoring of regulatory developments will be critical. Governments, financial institutions, and market participants alike are navigating a complex environment where technological innovation and policy intersect. By maintaining an informed, measured approach, investors can position themselves effectively while contributing to a stable and compliant market. That concludes our report on the projected timeline for potential government action affecting Bitcoin in 2026, and the steps that investors can take to remain informed and prepared.